All right, so it's 5 o'clock. We will get started as people so arrive. So I will introduce our two analysts in 1 second, but first we have to go through a couple of housekeeping items. So first, obviously everything you hear from any of us today is general advice, so we can't offer personal advice. What we would like, of course, is any questions that you may have. So I have put up the coverage list. The one thing I would ask is that if we could keep all the questions to the shares that actually Mark and Roy cover, that would be really helpful. But yeah, feel free to send through some questions. We'll go through a little bit of an introduction to kick things off. And then, yeah, would love your questions. So very quickly, we'll do some introductions. So maybe Mark, we'll start with you. I guess just a brief introduction and just an overview of your coverage. We can obviously see the individual names on there, but that would be great.
Okay, well, I cover energy companies and mining services space and some other odds and sods around that. So in the upstream space, oil and gas producers like Woodside and Santos, Beach, and so on. Also refined product sellers like Beaver and Ampol. And then in the mining services space, companies like Seven Group, Monadelphous, Downer, Worley, those sorts of names, and then some other odds and sods like Illumina and New Farm, that sort of thing.
Okay, great. And so, Roy, it's your first webinar with us, which is very exciting. But yeah, maybe a quick introduction and a little bit about your coverage universe.
Yeah, sure. So I cover the technology sector. So that includes the listing businesses, REA, Domain, Car, Sales, Seek. And then those are basically the marketplaces, and then the older marketplaces of the exchange businesses. So the ASX itself. I also cover the Hong Kong exchange, the Japan exchange, and the Singapore exchange. And then finally, some SaaS businesses, WiseTech, Xero, Technology One, and then PEXA is kind of part of the exchanges.
Okay, great. So maybe, and we'll go back to you, Mark, for the first question. I guess just an overview of what's going on within your coverage universe. Any themes? We obviously just got out of earnings season, so I don't know if there are any themes in earnings season or just in general in some of the companies that you cover.
Yeah, not so much in earnings season. It was pretty much as expected, but there is a sort of an overarching theme that covers most of my stocks or impacts most of them, and that's the energy transition. So you've got some old world companies that produce old world products like Woodside and Santos, hydrocarbons. How are they going to be impacted by the energy transition and the move to electrification of transport and that sort of thing? And then you've also got all the mining services companies who aren't really necessarily that exposed to mining anymore, but who are exposed to that theme as well in terms of being service providers for the build out of renewable energy infrastructure, the servicing of all that sort of thing. And how are the traditional companies going to navigate that road forward? How is oil demand going to look in a few years' time? How's gas demand going to look? That sort of thing.
Okay, great. We'll get into some of the specifics, but I think we've got an interesting contrast today because we have more, as you said, sort of old world companies, and then of course we have new companies. So I guess same question, Roy. So either out of earnings season or just any themes in general around technology. So there's been a lot of talk this year around technology, and
it's a good contrast. When his stocks go up, mine go down. Right.
Perfect. There you go.
Not exactly. So the theme for the tech sector over the past year and a half, and ongoing is the drying up of liquidity. As interest rates went lower, more and more capital found its way into especially the technology sector. That created a lot of activity, a lot of potential competitors for a lot of companies. But as that money dries up, it's a lot of tech companies had to lay people off because they overhired, especially during COVID. There's folks more on profitability, and you're just seeing some of those come through where nascent disruptor potential companies just turn out not to have all that great business models, and the strong companies are left standing, and the others are just deflating with interest rates going up. So that's probably the big theme.
Okay, and maybe just one kind of, I guess, interesting thing that obviously is happening that's been talked about a lot for the past couple of years is interest rates and inflation. And I guess maybe just in general, if we could talk about that, maybe since Roy will kind of continue on, particularly around, I guess, interest rates and how that's impacted maybe valuation levels in tech, that we saw last year. Of course, we saw tech in general not do great. We've seen it rebound so far this year and now not doing great again. So I don't know, I guess just some thoughts on kind of these growth companies and these emerging companies and how interest rates impact them.
Yeah, so I'm kind of lucky in that I cover the good technology companies. So it's the ones that are profitable. And like you mentioned, the more growth-focused ones that aren't really producing profits yet, their earnings are, if they're ever earnings, far into the future. So they're long duration assets. As interest rates move up, there's more focus on shorter profitability. For the company under my coverage, it's not the biggest driver, not as much as you would see in the growthier parts of the technology sector. The exchange businesses have positive interest rate exposure, so they will collect net interest income on balances, so they have a bit of positive exposure there, but it's usually not exactly what we talk about. When we talk about the technology sector, it's a bit old technology, but so those are some of the big impacts.
Okay, and then Mark, maybe kind of a different story, I think, that we've seen, particularly around some of the oil and gas producers that, were not doing well as demand dropped during COVID. And, I think coming out of that COVID period, I believe it was the cheapest sector in our coverage universe. And then obviously have done very well lately. And, I think a question we get a lot is, really as people look at, inflation starting to come down, but they're looking at maybe a period of higher inflation. How does that impact some of the companies in your coverage universe?
Right. Well, I guess the key is on the way up in terms of energy prices going up, companies tend to do very well because there's a lag between when the inflationary impact on the cost side starts to come through. So they get the benefit from the higher prices early, and their operating costs are still reasonable. And then on the downside, the reverse is true. So the commodity prices start to fall, so your revenues starts to soften, but your costs stay high. They don't drop off as fast, so you get a bit of an impact. So that has occurred to some extent, but right now we've still got very strong prices. So they're not getting the record profits that they got last year, but they're still making very, very good money.
Okay. And we do have, and before we get into some of the specific questions on shares, we do have a question that I guess either one of you could take if you'd like to, but Burton has a question, and he just wants to know what the time value for money, I guess not a specific formula, but what is that concept and how does that kind of impact valuations when we're looking at those cash flows out into the future, and then I guess the way that you guys are obviously taking those and bringing them back into a present value. So I don't know which one of you wants to jump on that one.
Okay.
I'll give it to the most senior.
I'm gonna
passing it around.
I like my ignorance here. It's just simply the value that is attributed to, I guess, you not owning that cash. If you're invested in a stock, that's money you don't have in your pocket. So there's a cost to that. And the way we calculate that cost is using a discount rate, which is effectively like an interest rate, I guess, interest you're earning on that money. So the time value of money, at the time you bought the stock, it was valued at X, and sometime in the future it's valued at X plus 1 because you're demanding a return on that asset.
Yeah, and it's also, I guess one thing I'd say, Burton, is, if you think about it, it makes logical sense, right? That $1 today is worth more to you than $1 out in the future, right? If somebody said, you want $500 today or $500 in 10 years, I think we'd all pick today. And so that's really that discount rate, right? We need to discount that, and we buy a company because we're hoping it generates cash flows in the future, but we can't just add all those cash flows up and say that's the value of the company, right? We need to bring it back to today. And I think kind of particularly with a lot of the technology where those cash flows are further out in the future, right? If you have a growth share, that you're not so much buying it really for what it's doing today, you're buying for hopefully years and years of profitability out in the future, that discount rate matters, right? So the higher the discount rate, the less that cash flow is worth. So hopefully that answers your question, Burton. But yeah, feel free to ask a follow-up one. If we look at your coverage, Mark, dividends are something that are obviously very popular in Australia with these profits that we've been seeing as we've seen particularly oil and gas prices go up. We have seen strong dividends. I guess, what's your view going forward? Because I know a lot of people have obviously looked at some of the iron ore producers, which of course you don't cover, but we saw really high dividends. We've seen them start coming down. I guess if there's maybe a generalization of sort of where you see from a dividend perspective some of those oil and gas producers that you cover.
Yeah, well, it's going to be a similar story to the iron ore producers. They tend to go up and down with earnings. So Woodside had a very healthy dividend last year. It's going to be lower this year, but it's probably the pick of the upstream oil and gas space because it has a very strong payout ratio, 80%. Even though it's got sort of considerable capital expenditure programs underway, it can still afford to maintain that. So from memory, it's sort of paying at the current share price something like a 6% yield, which is pretty good in a sector which is not well known for paying dividends consistently. So that would be picked there. In the refined fuel space, I think Ampol's paying a pretty good dividend, and it's fairly reliable too. That's another one that's good. Ventia in the mining services space, it has very low capital intensity, so it can afford to pay out quite a high proportion of its earnings. Just trying to think some other names. Yeah, I'd say those would be the three key ones. But yeah, especially in the upstream space, you're just going to have, it goes with the territory that they're going to go up and down with the commodity prices. So if you're looking for something that's not quite as exposed in that regard, then Ampol and Ventia would be a better bet than a Woodside.
Yeah, and you mentioned capital expenditures. So obviously that is these companies investing for more production.
Yep.
Do you expect them to continue to be high, those capital expenditures? Because that's obviously less money to pay out for dividend.
Yeah.
So you see that trend continuing, trying to take advantage of those higher prices by expanding production?
I think they'd be doing it regardless of the prices. They've just, there has been in the past, a sort of companies make the mistake of investing during the boom years and then the assets come on right when the commodity prices start to drop. But I think they sort of learned from that some years ago, and there's now a more consistent investment sort of profile. And upstream oil and gas companies are going to be investing in conventional assets, but they're also looking at sort of renewable assets as well, which is another aspect to what's going to happen in the future as far as capital expenditure goes. That's a bit of an unknown because it's still an untested market. Do they invest now in the lead up to what might happen in the future? How much of a gamble do they take? So fortunately, they all seem to be doing it fairly slowly and carefully. But they'll continue to invest for sure.
Yeah, and maybe one more question before we move on to Roy. You talked about in your opening, of course, the energy transition. We're hearing about it, but obviously oil and gas are not going away for at least a while. I mean, what do you see that transition period as being? I guess how long do you think that this is going to take?
Decades. So I think with oil, it's sooner. We expect oil demand to continue to go up till about the sort of early 2030s, and then it's going to go into decline. But it'll be a gradual decline, not as steep as some people think, because there's still going to be very strong demand from aviation for jet fuel and for chemicals and so forth. But for natural gas, it's going to be far longer. So natural gas is a big beneficiary of the energy transition, but from two angles, really. Firstly, it's the fastest and cheapest way to reduce a country's carbon emissions, rather, because it has half the carbon intensity of coal and about 2/3 the carbon intensity of oil. So if you're really quickly wanting to bring your emissions down, natural gas is the way to go. But it's also the peaking provider of choice too. So when the sun's not shining or the wind's not blowing, so your renewables aren't working, or your batteries have only got so much kick in them, then gas is the conventional fuel of choice to fill the gap. So it's going to be enjoying that for a good couple of decades, we'd estimate.
Okay. So let's switch gears. We'll talk a little bit about technology. So, we hear a lot about technology, kind of specifically with US tech stocks. And obviously, they've been a big driver of US market outperformance really since the GFC. Are there differences when we talk about tech shares? Obviously, other than the fact that the technology sector is smaller in Australia, are there differences when we think of those tech giants in the US and some of the companies under your coverage? And sort of what are those differences?
Yeah, so I think generally the technology sector is not a sector. It is a whole bunch of individual sectors and individual companies that have much wider variety of drivers than, say, retail or utilities. Like those you can call sectors, but within technology, you have all sorts of processes that are becoming digitized. So you might have WiseTech that digitizes logistics, and then you have Xero, which digitizes accounting. Those are the same business model, but they're not the same sector in many ways, right? So when you say the US tech sector has outperformed, like even there's chip manufacturers, there's corporate business software in Microsoft. So even there are different drivers, but I think a lot of them have caught a tailwind this year of the excitement around AI and what that can bring for all sorts of different angles. The technology companies in Australia have kind of caught the same wind for not really particular reason, right? But when tech goes up, there tends to be a lot of things in the market that just move in line that no one can explain. But
we look excitement and hype, and
we look at underlying cash flows and discounted cash flows, and that's kind of how these things go occasionally. So I'm not sure if that answered your question in full, but yeah, basically it's a lot of different companies and different stories. That's especially with tech something to really look at.
Yeah, and then you also cover a lot of exchanges, so we can see on the screen several exchanges internationally, but people are probably pretty interested in the ASX here, and it is a good opportunity, I think, based on the price and your fair value. Do you want to talk a little bit about, I guess, what makes an exchange a good business? And, we've seen some problems come out around the ASX, certainly around this whole blockchain issue, but maybe if you want to talk a little bit about exchanges in general, then specifically the ASX.
So exchanges are by arguably some of the best business models in the world. You have moats upon moats upon moats upon moats, some from regulatory monopolies, some of network effects. The moats reinforce each other. I invite our attendees to read those sections on moats. They are long sections for a reason. So the business model is super strong. Then there's an additional big driver for the exchanges that's kind of across all of them, which is just the return of volatility in a way. So if you think back 20 years, 30 years, It may seem like it's been a very volatile period, but arguably it's been quite subdued in many ways. So we've had the end of the Cold War, so there's not been big, impressive wars. We've had for a long time interest rates going in one direction. So that means you don't really need to hedge your positions as much. If there's an automated, if people have the view that there's an automated instinct of central banks to cut rates, that changes behavior a little bit. And then thirdly, there's been, especially in the last 20 years, really fast globalization, specifically moving manufacturing from the West to mostly China. And if you think about what that does to corporate earnings, it's really positive. You manage to keep wages low in one country and still get the thing. So those are all positives for the last 20, 30 years. But by many accounts, they're kind of reversing. So interest rates are going up again. There's a lot of reshoring activity happening, which affects wages domestically. It affects corporate profits. There's more tensions internationally. All of those things have the opportunity for exchanges to drive volatility. So that's generally across all four. ASX has an additional benefit in that when you think of exchanges, they tend to have a semi-monopoly for their catchment zone, so usually the country that they operate in. So if you're Japan, that tends to be the Japanese stock market and derivatives traded there. If you're Singapore, you try to go a little bit broader because you have a really small domestic market, so you try to do that. Hong Kong ties into China. Australia's stock exchange for a long time has been one of the higher margin ones, and the reason is, I believe that Australia is a big country, and as a result, there's a lot of mining activity here on a per capita basis, like logically by definition, and that means in many ways ASX is like the Nasdaq. What the Nasdaq is for tech companies, the ASX is for upstart companies in mining. So whether that's gold miners or now we go into the energy transition, it's lithium, it's copper, cobalt, whatever you want to come up with. The energy transition will require, and Mark will know this better, but an unfathomable amount of dirt being dug up. And if you want to set up an operation to dig up dirt, you got to raise some capital, and stock markets are the way to go. And they will very naturally gravitate towards the ASX. One, because that's the country that you operate in. It's also, there's the expertise. There's a lot of mining analysts here. Maybe you go to Canada, but probably here's a good place. So, tying those things together, business models that have very wide moats, volatility is on the way up, and then specifically for the ASX, there's the energy transition. There's an additional element for the ASX, which is just everything that's gone on recently. So I'll just take that to give a bit of a long answer. But the ASX has had some issues with what I would call its social license. So every business that makes money, especially when you make a lot of money, like exchanges do, you want public opinion to be in your favor. And when you have large IT projects going wrong, like has happened at the ASX, regulators start paying more attention to what you do. And if you make a couple of these mistakes, at some point it becomes more difficult for a regulator to see what good you're doing, right? So there's been outages, and all of those have kind of changed the public perception. And then the threat is that indirectly that will affect the different exclusive rights that the ASX has to certain services that it provides. As long as you're the sole provider, that's more profitable, of course. So ASX has attracted negative scrutiny, And what they've done in response, which I view quite favorably, is when mistakes are made, there's a couple of actions you need to take. One is you need to own up to it. You need to take responsibility, and that's not the one where you say, I take responsibility, so I keep my full paycheck and I cut 20% of my workforce. That's the wrong kind of responsibility.
Like the Qantas approach to issues.
Won't call names on that front, but we can all come up with examples there, and especially in the tech sector, it's been extremely frustrating. Like, what is the definition of responsibility here? But ASX has had responsibility taken, and what they've also done is they've tried to make sure that not just replacement of the clearing system, which had been the issue, but also throughout the organization, all the different systems, they're investing heavily to just make sure that they win back that social license. And that has been done with a level of decisiveness that in the short run will affect earnings because you're running up costs. But I think it's a smart investment to do, making those investments into upgrading your systems. Because you'll just in the long run be able to retain your license and your exclusivity. So we focus on moats. The intangibles of those licenses are a moat, and we think ASX has been extremely decisive in securing those licenses. Yeah.
And just very simply, how does an exchange make money? What's the main driver? Is it the number of companies listed? Is it the trading volume? What are kind of the drivers that you're looking for to drive earnings?
So there's a couple listings. Recently, there's been a couple of articles about how listings have been drying up. Of course, during COVID, when interest rates were low, there was a big spike in listing activity, but that's come off a bit. You can almost think of it as attracting a customer with a SaaS company, like conceptually. So first you attract a customer, that's the listing, and then you generate a long tail of ongoing revenue. So that can be trading activity. It's principally trading activity, clearing revenue from derivatives. And then you can sell the market data to market participants because they'll want to have instant data for high frequency trading. So those are the core drivers of revenue for exchanges.
Okay, and maybe we'll stick with you for a second because you did talk about moats, and you also mentioned software as a service, so SaaS companies. So we'll start with sort of the SaaS companies. Like, investors have liked them a lot, right? Because it is a really scalable model. But maybe if you could just explain what is it that's attractive for software as a service company. So I think WiseTech, Xero, Technology One, some of your coverage are software as a service companies, correct? Like, why do investors like that so much?
Yeah, the idea is that gross margins are very high. So theoretically, if gross margins at some point fall through to the bottom line, those margins should be enormous. What tends to happen, though, is that unless you have a moat, gross profits will not fall down to the bottom line as easily. So as an example, Xero does software for accountants, bookkeeper, or SMBs accounting needs. But SMBs fail frequently. So there's like a 10% churn per